Next we move to the Unit 2, Redemption of Preference Shares. First of all, we should know the meaning of preference shares. Preference shares are those shares which have the two preferential rights. First one, a right to receive dividend at a given rate before any dividend is paid on equity shares, subject to declaration by the company. Rate of dividend is mentioned on the face value of the share certificate. For example, 12% preference shares. Here, 12% is rate of dividend. Second one, a right to repayment of capital before equity shareholders at the time of liquidation of the company. Then we go for the redeemable preference shares. On such preference shares, the amount is refunded in accordance with Section 55 of the Companies Act 2013. Under Section 100 of the Companies Act, a company is not allowed to return to its shareholders their share money without the permission of the court. Redemption of preference shares, some important provisions we can see now. First one, redemption of preference shares means repayment of preference share capital to preference shareholders. The Companies Act 2013 allows the issue of redeemable preference shares if articles of association of the company so authorize or permit. No company limited by shares shall, after the commencement of this act, issue any preference shares which are irredeemable. The redemption of preference shares must be redeemed within a period of 20 years from the date of issue of such shares. Section 80, subsection 5A. To finance infrastructure project, a company can issue preference shares for exceeding 20 years but not more than 30 years. According to Rule 10 of Companies Act, shares and debentures, Rule 2014, the tenure of such preference shares cannot exceed 30 years and the company shall redeem every year at least 10% of such preference shares. Condition of redemption. Section 55 notes, such shares must be fully paid up. Partly paid preference shares must be made fully paid before redemption by making final call due and received. In case of call in arrears, such shares cannot be redeemed till they are made fully paid. Then second one, such shares can be redeemed out of distributed profit or out of the proceeds of fresh issue of shares made for the purpose of redemption. Then divisible profit. Profit which can be distributed as dividend. Capital redemption reserve can be created by transfer from divisible profit only. Example, divisible profit, surplus in the profit and loss account, general reserve or reserve fund, dividend equalization reserve, insurance fund or reserve, workman compensation fund, contingency reserve, provision for doubtful debts, provision for taxation. Only in excess of the required provision or a liabilities against such reserve or fund can be used to create capital redemption reserve. Then non-distributable profit. Profit which cannot be distributed as dividend. Transfer to capital redemption reserve is not allowed from this account. Example, security premium account, capital reserve, pre-incorporation profit, share forfeiture account, revaluation reserve, profit on sale of fixed asset or investment, debenture redemption reserve, investment allowance reserve, development rebate reserve. Investment allowance reserve and development rebate redemption reserve are available for capital redemption reserve only when specified in the question. Condition of redemption. Next, any premium payable on redemption of such shares shall be provided from out of the security premium account or out of the profit. And preference shares are redeemed out of the profit, an amount equal to the face value of such shares redeemed shall be transferred from the distributable profit to capital redemption account. The amount credited to CRR may be used by the company only by way of issue of fully paid bonus shares. Calculation of capital redemption reserve and net proceeds from fresh issue. CRR required equal to nominal value of preference shares to be redeemed minus net proceeds from fresh issue of shares. Net proceeds from issue of shares equal to nominal value of shares issued. Premium on such issue, if any, is to be ignored. If new shares issued are partly paid up, then only the paid up nominal amount should be considered. Fresh shares to be issued equal to nominal value of preference shares to be redeemed minus profit available for capital redemption reserve. Investment allowance reserve. A new section 32 AC has been inserted by the Finance Act 2013 to provide a tax incentive by way of investment allowance to encourage huge investment in plant or machinery. This is a new policy of the government which attracts the attention of businessmen in respect of investment in new plant and machinery. The deduction under section 32 AC is investment linked. Under this new section 32 AC, a manufacturing company is entitled to investment allowance at the rate of 15% of actual cost of new plant and machinery acquired and installed during the financial year 2013-14 and 2014-15 if the actual cost of a new plant and machinery exceeds rupees 100 crore. Next we will see the bonus shares. If the company has accumulated more reserves than normally necessary, it may distribute this excess reserve in the form of bonus shares. Bonus shares means the shares without cost for which nothing is paid by the shareholders. By making partly paid shares as fully paid, by issue of free fully paid new shares, then we see the guidelines of SEBI with regard to the issue of bonus shares. The company shall forward a certificate signed by its chartered accountant or company secretary to the effect that the rules regarding this have been complied with. No bonus issue will be made which will dilute the value or right of holders of debentures convertible fully or partly. Bonus issue is made out of free reserve built out of genuine profit or securities premium collected in cash only. Reserves created by revaluation of fixed asset are not capitalized. Declaration of bonus issue is not made in lieu of dividend. Then the proposal must be implemented within 6 months from the date of approval by Board of Directors. The company has not defaulted in the payment of statutory dues, interest in respect of fixed deposit and interest on debentures. If provision is not there in articles regarding capitalization of reserves, the company shall pass a resolution in its general body meeting. If authorized or subscribed capital increases due to this, a resolution shall be passed in general body meeting to increase the capital. Then we will see the various journal entry with regard to the redemption of preference shares. First, for making final call on partly paid up shares, redeemable preference share final call account debtor to redeemable preference share capital account. For receiving final call amount, bank account debtor to redeemable preference share final call account. The next one, for sale of investment, for example at a loss, bank account debtor, profit loss account debtor to investment account. Then for new issue of debentures or bonds, bank account debtor to debentures account to bonds account. Then for new issue of shares at a premium, bank account debtor to share capital to securities premium. For transfer to capital redemption reserve, general reserve account debtor, profit loss account debtor to capital redemption reserve. For redeemable preference share capital payable on redemption at premium, redeemable preference share capital account debtor, premium redemption account debtor to redeemable preference shareholders account. Adjustment of premium payable on redemption, securities premium account debtor, profit loss account debtor to premium redemption account. Entry for cash payment, redeemable preference shareholders account debtor to bank account.